Hi, it's Nuttall at Ninepoint Partners. Thanks very much for tuning into this webcast. The purpose over the next 20 or 30 minutes is to give you a brief update on the oil markets. We won't spend very much time on natural gas given the timeliness and how topical the oil is given the sell-off both in the commodity and the oil stock. So what I would like to cover, we have four main topics. The first, I want to give you an update on the market rebalancing, kind of where are we now. Secondly, I'd like to talk to sentiment and why there is the largest dislocation in history between the commodity oil and oil stocks. Thirdly, I'm going to walk you through our thesis in terms of why we're in a multi-year bull market for oil, and then I'll end off in terms of how we're positioned in the Sprott Energy Fund to maximize what we again see as a very, very positive investment climate for at least the next 4 to 5 years. For those following along in the slides, on slide 9, we walk through how greatly the oil market has improved, and we'll go through the reasons for this, but it boils down to the combination of weak supply growth, mainly U.S. production growth that disappointed last year, combined with very strong OPEC compliance as a result of their curtailment deal. That combined with incredibly strong growth in 2016 and 2017 has seen the oil glut that the media seem to reference on a daily basis fall by the greatest extent in history. So coming into the year 2017, there was 334 million barrels of excess relative to the 5-year average, and due to a multitude of factors, that fell by our estimates to about 70 as of the end of December. So that's a drop of 264 million barrels, and we were very, very vocal throughout the year, first in the beginning of the year predicting this trajectory, and lastly reporting on it in real time. When we look to how the rebalancing will continue to play out on slide 10, what we show is our best case guess, and we know we're going to be off by a month or 2 months in either direction, but we think the market is going to enter into a state of undersupply at or around May of this year. That's a full year ahead of what many forecasters still have, and it's encouraging to us to see some of the name brand Wall Street firms catch up to where we've already been for the past 6 months. And notably last week, Goldman Sachs put out an upgrade both to their oil deck, raising their oil price forecast this year for WTI to about $72. And the key reason was because the market rebalancing is happening faster than what they had thought. So it's encouraging to see the likes of Goldman Sachs and others catch up to where we've been for a little bit. Also, I would point out what on slide 10, what we show is we think that OPEC compliance will continue. We think the curtailment deal will be extended into 2019, and as a result, OPEC is going to overshoot, meaning the market is going to become much tighter than what they thought, primarily because they and many are using stale demand forecasts from the IEA, who has chronically underestimated demand. It's our guess, and those of whom we follow, that oil demand growth this year will be at or around 1.8 million barrels per day. That would be stronger than consensus of about 1.4. So that 400,000 barrels per day of additional demand above what consensus would have means that the market is tighter now and will remain tighter going forward. Hence, the drawdowns are going to exceed expectations. So we see a very, very positive climate for the oil price. Turning to slide 12, what we show is there's really been 3 drivers for the rebalancing. The first is obviously OPEC, their historic deal that was struck in the fall of 2016, effective January 1st, removing about 1.2 million barrels per day. And I would note that compliance on the part of both OPEC and Russia have been incredibly strong. And we, from the very beginning, were very vocal in our belief that due to the requirement of self-preservation, given the dramatic fall-offs in cash surpluses, the currency and such, that the primary member states of OPEC, being Saudi Arabia, would maintain very, very strong compliance, and that's exactly what we've seen. Secondly, we had thought that U.S. shale growth was going to underwhelm and come below consensus, and that has come to pass. We're going to walk through the reasons for that. And thirdly, as I alluded to, very strong demand growth last year. We're still waiting to get confirmed numbers, but demand growth was up about 1.8 million barrels per day. That's a very, very strong number. The 10-year average is about 1 million barrels per day of growth, and the 5-year average is about 1.2 million barrels per day of growth. So we're seeing there's not just one epicenter like China of the years past. It's a broad-based global recovery being expressed in very strong demand growth, despite all of the Tesla concerns that we'll have to address in one slide later on. Slide 13, we just show how the OPEC compliance has exceeded 100% since the deal. That's removed 1.2 million barrels per day off of the market. There was a bit of slippage early on in 2017 between exports and actual production cuts, but that tightened up in the second half of last year. And what we've seen in recent months is Saudi exports continuing to meet new lows. The next topic is U.S. shale growth, and this is very, very important given that the U.S. really is critically the swing supplier in the United States. What we've seen over the past 5 years is a failure, basically, of an experiment that the financial markets and U.S. shale producers tried, and that was they threw massive amounts of capital at shale deposits. So whether it was started in the Bakken, then went into the Eagle Ford, and now is going into the Permian. And what it saw was this massive, massive outspend, which resulted in a massive amount of debt being put on the balance sheets of E&Ps. And really what it resulted in was just a massive amount of negative free cash flow and negative returns, because you put too much pressure on the service companies, you get service cost inflation, and you get terrible returns for incremental dollars spent. What this has led to over the past year has been a rotation of investors where growth investors have sold oil and gas companies to go buy Tesla stock, and value investors have come back into the space. Value investors approach things much differently than growth investors, clearly. They're, rather than just growing for growth's sakes, what they've been pressuring executives, and this started about mid last year, and it's only getting stronger. They're strongly encouraging executives to taper back on their growth, taper back on their spending, align spending and what they spend relative to what they cash flow, and any incremental free cash flow above and beyond that goes back into the form of dividends or buybacks. So what this means is that the E&P sector will be spending less than what one would think, given oil still at around a 3-year high and in excess of $60. So the going forward growth rate is going to be less than what people believe. And what we show on slide 15, and this is a great slide that we borrowed from ISI, is just to show beginning in Q3, this is the number of times the word returns was used in corporate conference calls. And you see basically it was flatlining in the 100s. And as a result of this crossover from growth to value investors, it spiked in Q3. What we've also seen is beginning in February, when new compensation plans come out in the United States, there's going to be more and more alignment of executive compensation with more returns focus, such as like return on capital employed as opposed to just absolute growth. We give on slide 16 some examples of this from conference calls. I'll let you peruse that, but there's a very, very meaningful change. And in fact, Royal Dutch Shell just reported earlier this week, and they said it was of paramount urgency that they deploy incremental free cash flow to increasing their dividend and doing share buybacks. So there's been a very, very profound change in mindset, and that is not being appreciated by the market. If you ask most people, and I'm jumping ahead here, but if you ask most people, well, why would you be bearish on the price of oil? It'll be U.S. shale. U.S. shale is just going to grow too much. That is an antiquated belief. The third aspect is demand growth. Last time we'll talk to this. Just to point out that demand growth has been increasing at a very, very strong rate. And it's not just China. It's no longer just a Chinese story, and no longer is it just an Indian story. It's a global recovery in economies, and that's being expressed in very strong increase in oil demand, specifically for transportation and specifically for jet fuel. It's not just gasoline demand, and that's important when we talk to Tesla in a few minutes. So demand last year was up about 1.8 to 1.9 million barrels per day, very, very strong relative to the 5-year average. And if I can borrow again work from Goldman Sachs, because it was the most recent one that I've seen last week, they're estimating the demand will actually grow by more than 2 million barrels this year. So in terms of sentiment, okay, so that's great. The market's rebalancing. We have oil at a, call it a 3.5-year high before the sell-off over the past couple of days. Why is sentiment as bad as it is? not just towards equities, which we'll talk to later on, but towards oil. Why is there just no buy-in despite people having all of the evidence right before their eyes? We can highlight 4 reasons for this. One continues to be electric cars, even though over the past couple of months, due to a lot of good work coming out, I think it's alleviating people's concerns about how Tesla will not be taking over the world anytime soon, how when you survey people, not everyone drives an electric car, nor will they be purchasing one in the next couple of years, and we'll walk through some of the math. So that was a bit of a mania in terms of fear levels last year, and that's starting to taper off. The second reason why we think sentiment is poor is that people look at the oil curve, and that's just the future strip or the forward price of oil. It's very high now, but because it's in backwardation, that price drops off over the coming years, and I think people are misreading into that, and we'll touch on that. Thirdly, people are concerned, well, here we are at Brent price around $70, again, multi-year high. Surely you're going to see cheating and the deal between OPEC and Russia crumble this year, and that 1.8 million barrels that people reference, despite it being about 1.2, is going to swamp the market. We'll touch on that. And then lastly, again, I kind of touched on this, but it comes back to US shale. And my God, these companies are getting so bloody efficient that it's lowered the supply cost. And that's just a profound misunderstanding. Anybody who spews that just simply doesn't have an understanding of what has actually been going on, and we're going to touch on that. On slide 19, this is our Tesla slide, effectively going through the logic behind why we're not terrified being an energy fund manager for the next 10 years. And it comes down to, while the growth rate of electric car sales is most certainly increasing, when you look at the impact of that on demand destruction relative to a growing global economy and the growth of internal combustion engines worldwide, we're many, many, many years away from the adoption of electric cars eroding the demand growth for oil. And part of that, I'm going to be doing more work on this in the months to come, is, oil is not just used in cars, it's for transportation, it's also airline, long-haul freight and such. But when we just look at cars, and I'm borrowing this number from Goldman again, for every 1 million electric cars that are sold, so in lieu of internal combustion engine, that leads to demand destruction of 14,000 barrels per day. So that may seem like a lot, but again, demand was up 1.8 million barrels per day. And given that electric car sales last year was about 1 million, that would mean that demand destruction we did result in 14,000 barrels per day, and yet demand grew by 1.8 million. So to call it a rounding error would be modest. We show some estimates, and I could show you like 20 of these. They all point to the same conclusion, and that is we're borrowing this from Pyra on the bottom left. They have a high adoption case and their base case. The conclusion is the same. Oil demand will continue to grow out till 2030. So it makes us mildly comfortable still looking at or being an energy fund manager for at least the next decade. Secondly, I touched on this oil backwardation. So people are looking at the oil strip, and the strip today when we came in is an average price of about $62 this year, falling to 57 in 2019, falling to 54 in 2020, and falling to 52 in 2021. So people say, my God, the oil price is going to be falling. Why the heck would I ever buy energy stocks? And the reason why you would buy energy stocks is that if you did an analysis of the predictive capability of the strip, and if you were to say, okay, so today, the strip for 2019 is $57. The price of oil today is about 63, but this says it's 57 in 2019. And you look at the predictive capability of that price if we were to meet, in a year from now, and the capability of the strip to forecast the appropriate price is called an R squared, a correlation of only 0.17. So that means that the strip has no predictive capability whatsoever to predict what the actual oil price is going to be. So it's a irrelevant and useless piece of data to use. Unless an oil producer is completely hedging that off for the next 5 years. And we just show a graphic that we borrowed from CIBC to show what was the strip at that moment in time and then what the actual oil price was. And you can see that there's no correlation whatsoever. So for that to have a negative consequence on sentiment is mildly moronic. Third is, so the OPEC deal. So as important as this has been in helping to balance the market, it's very important to appreciate that there was a bit of cheating going on in 2016 leading up to the deal. And the reason for that was the deal was never supposed to be a production cut. It was always going to be a production freeze. And I think sentiment was so bad that OPEC realized that that was not going to shift people's expectations for the oil price. So it resulted in a cut. But if it was just going to be a freeze, what you want to do as a producer is ram as much production into the system as you possibly can leading up to that meeting. Then you're producing at an artificially high level, and then if you have to freeze there, then that's fine, because you're already producing at a level above and beyond what your reservoirs and your financial capability probably would have allowed you to do. So while we saw in 2016 this super strong ramp in production, and the producers then cut production by the advertised 1.8, the producers now are effectively producing at their full-on capability if you exclude Saudi Arabia. So we would expect the OPEC barrels from both Russia and primarily Saudi to come on in a very measured manner, probably over a 2-year time period, depending what the oil price is. And the Saudi oil minister, the Crown Prince, Vladimir Putin, have all said that they will be very careful not to, swamp the market. And why would they? That would be utter stupidity. They've achieved their desired goal almost. Like the market is already is almost rebalanced. We have oil at multi-year highs. Why would they swamp the market after enduring what they've endured over the past couple of years? So lastly, and just to touch on the final reason why we think people are pessimistic on oil, and again, it comes down to U.S. shale. And there's a profound misunderstanding in terms of the efficiency story. So you'd be led to believe, if you were to meet with a U.S. Producer, that as a result of technology, the well productivity has gotten so good that supply costs have been lowered to below like $30 in some cases. Some companies will say, my God, like we're earning a 100% rate of return at $30 oil because our finding costs are only like $5 and such. And there's so much misinformation embedded in those statements that we think that the results are starting to show that you're getting inefficiencies. And we've got a couple of slides to speak to that. But the crux of this is that, earlier I mentioned that fiscal discipline that's being beaten into the heads by value investors into oil executives. Even if you were to exclude that, at strip pricing now, at the oil price today, we would expect oil production from the U.S. shales to maybe get to like 1.3 million barrels per day. Our base case is like 1 million, but that excludes spending constraint. It excludes profound shortages in terms of services. So pressure pumping, which is a key investment theme for us, sand shortages, labor shortages, which we've all written on in our monthly commentaries in the past couple of months. If you ignore all of that, the U.S. will grow by about 1.4 million barrels per day. Demand is growing this year by 1.8 to 2 million. So even going forward into this year, even if there were no encumbrances in the United States shale growth, it would still not be enough to satisfy demand growth. And we'll go through why when we go outside of the U.S. and outside of OPEC, we think production is and will be going into free fall for the next 4 to 5 years, which is the core of our bull thesis for the oil price. We quote a study that came out at the end of last year from MIT that said that the U.S. Is vastly overstating their oil output forecast. And what they speak to in their study is that it hasn't been technology. It's been high grading. Companies have been drilling their very best rock, and when the oil price is cratering and you're hanging on for survival, obviously you're going to drill your very best rock because you get your best productivity. But eventually you exhaust your what we call core acreage or tier 1 acreage, because Mother Nature is very heterogeneous. It's not these homogeneous shale blobs. There's a lot of variability in terms of the overall quality. So as these companies stop high grading, well efficiencies will start to erode. And we show a graphic on slide 24. We've been using this for a while. It's just a good picture of the U.S. Bakken play. All shale plays are the same. There are good areas and there are bad areas. And note how small those very good areas are on the left in red. When you go into the yellow and then the green, you probably wouldn't even drill. So you just recognize how small of an overall play that core acreage is. And the MIT study was the very first one really to be able to demonstrate that. Slide 25, what we show is there's already evidence of efficiencies stalling out. And the reason for that is that companies have pretty much thrown, and you never want to doubting technology that gains, you always want to be a little hesitant of. However, when you look at what companies have been doing, they've drilled longer. So companies are now drilling 2 mile up to 3 mile well bores. That's 200 to 300% longer than average. They're there. Companies have figured out how to do multi-stage frac design. So you're putting in more and more stages. You're making the spacing between those stages tighter and tighter and tighter. So you're rubblizing even more rock. In each of those frac stages, you're using more and more proppant loading and more sand. And there's evidence now in the US that the average frac sand used on a stage basis is now starting to flatline. Companies have figured out where to land the wellbore in the very best area of the geological zone and such. So all of these things are happening, and yet what you're seeing is productivity gains are flatlining. So that tells you that either industry is drilling crummier and crummier rock, or as a result of an exhaustion of the talent pool in the labor pool, that you're getting more and more inexperienced people coming to work, and you're seeing that across the board. And in my conversations with service companies, there is a very, very, very significant shortage of labor, both in pressure pumping and in trucking. So that's leading to inefficiencies. So we think that's a very, very important aspect to consider. Slide 26, we borrowed this from Jeffries. They just show, the strong efficiency gains, productivity gains in the Delaware Basin and Midland Basin. Those are the two areas of the Permian, which is the only area of meaningful growth in the US and by extension in the world. And look at this dramatic drop off last year relative to previous years. Others have alluded to this. For those of you that get direct emails, I sent out a story, and I transcribed an interview from the Saudi Arabian energy minister, which I thought was very, very important. This was at the end of January, where he put into context U.S. shale and speaking to how everybody just focuses on the U.S. Nobody speaks about the countries in massive decline, where you have Venezuela production just imploding, Mexican production falling off. Canada will be going into declines in the coming years. You've got the North Sea in decline, China in decline. Like, nobody talks about that. People just focus on the one area, which is the U.S. So in a global context, the U.S. shale is not enough to offset global declines and also meet demand growth. And I'll let you read that on your own time. So just showing slide 30, the Permian Basin is really the one remaining area of growth, and already you're starting to see some bottlenecks in terms of labor and services there. So we think people are overly optimistic in terms of how much the U.S. will be growing. So slide 31, why are we in a multi-year oil bull market? Then there's really three aspects to this. One is U.S. shale, which we just talked about. Yes, we believe U.S. shale will grow by about 1 million barrels per day per year for the next couple of years until they exhaust their core acreage. Maybe we're there, maybe we're a couple years away from that occurring. But the U.S. growth is not enough to meet demand growth combined with global declines. So then you're left with the only two other areas, and that's OPEC, and then you've got non-OPEC, non-U.S. production. We believe, and we'll talk to this, how that once the OPEC barrels come back online, that OPEC, generally speaking, will be producing at max operational capability. And we also think that the remaining countries, that's non-OPEC, non-US, will be going into decline beginning in 2019, and that will persist for the next several years due to the greatest level of underinvestment in the history of the oil and gas business. So on slide 32, we just kind of summarize that as well. Plus, we're pretty bullish when you look at demand growth over the next couple of years. Slide 33, we've used this slide, we've updated it, but it's a very, very important slide. On the left, this shows that we've had the biggest drop in spending in the history of the oil and gas business. That's incredibly important because this is spending not on shale wells where it takes you 4 to 6 months to bring on a project. This is on very long lead projects that take 4 to 6 years to come on. So these would be like the big offshore Gulf of Mexico projects, offshore East Africa, Guyana these days, the Norway. There's been a couple of big discoveries, and that's wonderful, but you're like 6 years away until they're going to come online. And what that means is that as spending stopped really in 2014, there wasn't an immediate impact because companies and countries were harvesting projects that were sanctioned 3, 4, 5 years ago prior to that. But when you fast forward beginning in about 2019, 20, and 21, you get a very significant fall off in non-OPEC, non-US production. And when we look at slide 34, production was already flat, and we think that's going to go into declines given the drop-off in spending. When we look at 35, and this is very good work by Simmons, I think they do excellent macro work. Their focus on what they call international non-OPECs, that'd be non-OPEC, non-US, is production will grow by about 100,000 barrels this year. So in the grand scheme of demand growth of 1.8 million-ish, it's a rounding error, and production will go into decline beginning in 2019 and accelerate going into 2021, 22. What that means on the right-hand side is the call on US and OPEC. And look in 2019, 20, and 21, depending on high case and low case. But even on a low case, beginning in 2020, the US and OPEC have to come up with 3.5 million barrels. We think the US, like if you had no labor constraints, and if you had all the value investors leave and growth investors come back and it's guns a-blazing, all out spending, they can grow by like 1.4, 1.5. We really, really struggle to see where the incremental barrels within OPEC are going to come from when you appreciate some of the profound challenges that many of those countries are facing. When we look at 36 as well, we see we've already had a flattening really in production outside of a few primary countries. The only countries where we see any meaningful supply growth potential are those that have very significant geopolitical risks, such as like in Libya and Nigeria. And when we look at slide 37, there's been a multi-year trend now of lower and lower spending, and that's coincided with fewer and fewer discoveries. So we talked about this 3 years ago, then we talked about it 2 years ago, and now I could talk about it now. There's a persistent and chronic lack of discoveries. So not only are there are fewer discoveries, but what Rystad points out to on this, and I'll let you read this on your own time, is that the size of the average discoveries are getting smaller and smaller. So again, it speaks to the maturity of global basins. 38, lastly, and then we'll go into positioning, I think, is not only is the lack of investment resulting in fewer project sanctionings, but it also means that companies are underinvesting in current production. So if you have ongoing facilities, you're just not doing the same amount of maintenance work that you should be doing. So that's leading into a higher, what's called a depletion rate. So a decline rate would be the loss of production globally from the reservoir pressure that you're using up. It's thought to be about 3 to 4%. And given that we're producing almost 100 million barrels per day, that means you lose 3 to 4 million barrels per day of production. The depletion rate is how much of your known deposit are you producing. And due to the lack of investment, and I borrowed this from Schlumberger, I'm looking forward to getting an updated slide from them hopefully soon, you'll note that the depletion rate has really, really gone up as well. So that just means the companies are pulling on their existing fields harder and harder and harder. We're not alone in thinking that there could be a shortage. You can feel just as people are catching up to where we were on the market rebalancing, you're starting to get the first whiffs of some major brokerages starting to write about it, and that will be critical in shifting sentiment on the oil price. So just to wrap up on the macro discussion, the oil market is rebalancing. Oil inventories, or the surplus, fell by the fastest rate in history. Demand is growing very, very strong. U.S. supply is disappointing. And beyond OPEC, which is out of spare capacity once they bring on incremental barrels, which represents about 2/3 of 1 year of demand growth, the rest of the world is in free fall for production. And given how long lead the investment cycle is, even if oil price spiked today, like let's just go crazy and say in 2019 you could have a $70 or $80 oil price, the ability outside of OPEC and outside of the US to respond to that high oil price by bringing on incremental barrels is challenged, because if they sanction spending today, you'll start to get it in 2022. So we see a very, very good investment climate for the next 4 to 5 years until non-OPEC, non-US countries and companies can respond to the high enough oil price by incremental project sanctioning. So that what that means is basically, so long as we don't go into a global depression, the oil price will have to go high enough to rationalize demand. And that would be a oil price meaningfully higher than where we are today. So turning to 41, how are we positioned for this? Last year, and I'm looking forward to not having to talk to 2017 again after this call, like last year was epically challenging. because we thought that the market would rebalance, and we nailed that call, I think, better than most. We were positioned in some themes such as frac sand, where we identified a major theme that due to an increase in drilling and pressure pumping, that there could be a shortage of sand that'd be expressed in a price increase, and you'd get wicked margin expansions, and these companies were much, much cheaper than what people thought. The themes played out, but we failed to make our unit holders money from that, because what we experienced, what the market experienced, was the largest dislocation between the commodity oil and oil stocks in history. There were many examples where oil last year was up both in US dollar terms by about 8 or 9%, we'll touch on that, and in even Canadian dollars, despite the rally in the loonie, by about 3 to 4%. And you had examples of oil companies falling by 50%. And even today, this year, year to date, we were having a decent January, the market was as well, and here we have oil up about 5%, and you have oil stocks, some falling another 10 to 15% as a result of really, really crummy sentiment due to the reasons I spoke to before. So we thought we were positioned very well. The companies were doing incredibly well, the stocks were not. We're optimistic that at some point, when sentiment shifts, there will be a realization in terms of how unbelievably inexpensive the companies that we own are, and there will be a very, very significant re-rate in those names. We're positioned for a turn in sentiment. We're positioned, I hope, and I think better than our peers, because we're not hiding out in the midstreamers. We're not hiding out in Suncor and C&Q. We have focused bets or positions in companies that we stay in contact with on a weekly or monthly basis, and we know that the companies are doing well. We just need the stocks to better reflect that. So we're carrying a beta. This is as of December. That's kind of stale. So the portfolio beta right now is about 150%. We see very meaningful upside, higher than what the numbers on this page would be. We've been repatriating some money back into Canada, given how awful sentiment is here, and we've been, we're negative as well. When we look at takeaway capacity, we've run out of pipeline takeaway, both for natural gas and oil. We have significant issues in some commodities, but there are very exciting pockets of opportunity within Canada that are being completely overlooked. So we're about 60% Canada, 40% US. We're entirely hedged on the currency for our US exposure. We are 55% in services. That would be a significantly higher weighting than any other energy fund in the country. And we'll go through the reason why. We're very bullish on the service sector. We're 38% invested in oil, and we own 2 natural gas names. So that's about a 7% weighting. And we're very bearish on gas. However, we do think that there is a positive catalyst coming in the next couple of months. And we think we own 2 natural gas names where if natural gas on one of them went to zero, given the infrastructure and the liquids and oil that they produce, you're not paying for the natural gas business anyways. So that's how we're positioned. So the first major theme is services. And as I mentioned, this is about 55% of the fund. Within services, we're really targeting pressure pumping in the United States and in Canada. We think that despite there being fiscal prudence in terms of realigning a little bit more spending with cash flow, that the demand for pressure pumping will grow very meaningfully from about 16 million horsepower in the US to about 21. So that's growth of about 5 million. We also think that given the increase in intensity of frac designs, meaning these crews now work 24/7, so you've got shift changes, so you've got equipment working 24 hours a day, 7 days a week. They're using more and more sand. There's more and more wear and tear on the equipment, that the attrition rate, so that's how much of your overall capacity goes down, is at a conservative level 20%. So that means you'd be losing about 3 million of your horsepower. So that means you need to come up with 8 million of new build capacity. The most recent number we saw was 5, and that caught people off guard. That would be viewed as a very bearish number. However, people are not estimating how great the growth is going to be, and people are completely forgetting about attrition rates. So we think the market will remain undersupplied. We think pricing in the United States is going to continue to increase beginning in Q2 throughout Q4. And our names, we own many names given especially the sell-off as a result of the Dow and further dislocation between fundamentals and reality. We have names that have fallen by another 15-ish% this year in the United States. and the same is in Canada. So our largest, we have two large positions in Canada. One of them is down 15% on concerns that weak natural gas prices will lead to less spending on the part of natural gas names, and they have about 15 to 20% exposure to those. I met with the company last Friday, and their strong belief, and some of their competitors, is that the growth of demand in liquids-rich gas and oil is going to offset the dry gas. So this is a name that's fallen by 15%. They have a $100 million buyback, so that represents about 10% of their market cap. There's the potential that they could increase that. So what they're saying is we're trading at a 19% free cash flow yield and 3.5 times EBITDA. That's stupidly cheap. And if you don't want to buy our stock, that's fine. We're going to buy it back because that's the best investment we can identify. So because of this dislocation between fundamentals and the market, perception and reality, you can pick up these names that are trading at levels that we've never seen basically in our career. The second major theme is in oil stocks. So again, that's about 38% of the fund, where beginning in 2017, and this trend has continued, you've seen oil increase, and yet you've seen oil stocks like just get annihilated. Household names like a Crescent Point, names like a Cardinal, were down in excess of 50%, while the oil price, both in US terms and Canadian dollar terms, has risen. And despite a widening in differentials, even for light oil in Canada, the price of oil in most cases is still up, depending on where you produce the oil, so whether it's parts of Alberta or Saskatchewan and such. And given the sell-off that we've had in the broader markets, you've seen oil stocks fall another 10%. So what we show on the chart is, here's oil up 24% from when I printed this chart off to beginning of 2017, and you have some names down 60%. It's very difficult to try to explain that. However, what you get is the ability to buy oil companies trading at about half to two-thirds of their historical multiples, using strip pricing for 2018, or even using our forecast, which is $60, and that's just a flat-out guess. So some names we can pay literally 4.5 times enterprise value to cash flow, where they used to trade it at 8 times. So that's, call it 40-ish%. And a growing theme, what you're going to see is increase in dividends from Canadian dividend-paying companies, and what I'm hoping for meaningfully is increase or initiation of buybacks. Because many companies, and I'm just going through my sheet that I have, if companies were just to go to maintenance mode, so to stop growing, keep production flat, in many cases they could they could buy back 10 to 15% of their stock. So again, valuations have gotten so low that the best investment for these companies is just to buy back their own stock rather than drilling wells. And that's a conversation we're having with many of our holdings, and we think we're having some success on that front. So those are our two major themes. Service stocks that do tend to be higher beta, where they're experiencing the best margins, like their corporate profitability is the highest in 3 to 5 years, and yet because of a concern about overbuilding of capacity, their stocks are down, and they're trading at, let's say, half of their historical multiple. Usually they would trade at about 7 times. Now they're trading at 3.5. We have names trading at 10 to 19% free cash flow yield. So theoretically, in 5 years, some of them could buy back all of their stock and basically be a private company. And then we have oil companies trading at 4.5 to 5 times when they used to trade at 8, where they have the ability to buy back 10 to 15% of their stock. So there's been such a breakdown between valuations and oil fundamentals. We're confident in the upside. We're just not confident on the timing. So I cannot provide any visibility for when that sentiment shift occurs, but compensating you for that uncertainty is the very, very meaningful upside that we see in the sector. And again, as a backdrop, we believe we're in a multi-year bull market for oil for all of the reasons that we've gone through. So we thank you very much for your time. We went a little longer than we had anticipated, but as always, I am extremely accessible. If you have questions in terms of positioning or our macro calls, please either reach out through your wholesaler, or for those of you who have direct access, please feel free to reach out. Thank you very much for your time.